Welcome, everyone. I'm Cathy Clark. I'm faculty director at Case at Duke, and I'm excited to be here, excuse me, on behalf of Fuqua's LinkedIn Live series today. Case is a research and education center at Fuqua that prepares leaders and organizations with the business skills needed to drive positive social impact from wherever they sit in social ventures, investment firms, corporations, nonprofits, or government agencies. And we've had a special initiative focused on impact investing since 2011 called Case I3. And we'll share a link to that shortly. The title of my talk is Balancing Rigor and Realism. I want to ask this question today. Can emerging impact management practices combat the practice of greenwashing in the sustainability marketplace? There are very real pressures facing those investing for impact, and many, including the U.S. Securities and Exchange Commission, are calling for more rigor in disclosure practices to help funds wanting to avoid accusations of greenwashing. Will it be enough? Or do investment funds need to fundamentally change how they operate by adding in specific impact management practices? I'm going to share some context for my answer to this question and then share some findings from some research that we've done in the last year on this topic. That's going to take about 20 minutes. Then I'll answer questions for about 10. So please feel free to submit your questions as a LinkedIn comment throughout the session, and we'll try to answer as many as we can in that last 10 minutes. So first, I want to provide 3 points of context. There has been significant growth over the past 2 decades in impact, ESG, and sustainable investing. This chart, produced by an organization called USSIF, which studies the US market, shows the growth in asset managers and allocators adding ESG factors, or environmental, social, and governance factors, to their investment practices. I like this chart because it also shows 2 important things. One, that the total assets invested for sustainability in the US has grown steadily in the past decade and peaked at over $16 trillion under management in 2020. It also shows that today, the same researchers are saying the market in 2022 was only about $9 trillion. So did it shrink? Did people stop investing in ESG? No. In fact, what happened is that the use of the label ESG started to become just a little too popular and therefore meaningless. Funds could call themselves ESG funds with no real change in their everyday practice. And this is what we mean by greenwashing, basically pasting a label on the investment container without changing the content of what you're doing. Not very helpful to anyone really, and potentially misleading if you're trying to make change with your money. What we really want to know is, what are you doing differently with your assets to drive change for people and planet, and is it effective? So the US SIF decided to get pickier with which funds they'd count, and so the $9 trillion in 2022 was a more conservative and therefore more trustworthy number. It includes funds that have at least one defined ESG strategy, or they have a full-on ESG focus. As many of you may know, the SEC has also gotten pickier, and earlier this year increased their guidance and scrutiny of funds using different labels, including ESG. The names rule, adopted in September, requires investment funds to allocate at least 80% of their assets to align with the names or terminology they use to characterize their investment strategy. And it comes with new disclosure and audit requirements. And we're going to post a link so you can learn more about that. You can also see in the orange and tan segments on this chart that there's growth in the amount of money under management by funds that are engaging in what we call shareholder advocacy. This is investors who are engaging with their current holdings to make their wishes about sustainability and impact known to the companies that they're investing in. So here's what I want you to keep in mind from this. In the public markets, we have about $9 trillion investing in ESG and sustainable outcomes, and about a third of those are actively engaging to change company behavior. Now, let's look at the private markets. This is where private markets are assets that cannot be shared publicly. have to be privately bought and sold. This is where much of the impact investing market has historically taken place. The market has been sized by a group called the Global Impact Investing Network, and their most recent estimate is that the private market impact investing globally, which includes things like private equity, private debt, community development, international development, philanthropy, and corporate impact investing, has increased in 2023 to just over $1 trillion. So taken together, we can see that the public and private market investing for impact on people and planet is both growing and is starting to reach a significant size. Estimates put this activity at between 1/5 to 1/3 of the total assets under professional management globally today. And with deep policy support for private sector investment in climate change and other issues, as we learned about at a spectacular event we held last week at Fuqua, this is point number one for you. Investing for impact as well as returns is getting real in size, even with more conservative definitions. Point number two I want to make is that impact investing is happening across all asset classes. The GIN defines impact investing as investments that are made into companies, organizations, and funds with the intention of generating social or environmental impact alongside financial returns. So it's actually a set of investment practices, the intentionality and the accountability that can be applied to any kind of asset. So when it comes to investing for impact, you see that the activity can and does include both market rate, which is in blue on this chart, and below market investments. This is a chart from the Heron Foundation, which took their entire endowment and invested it for impact across both parts of the spectrum. So what we see is asset owners are asking their allocators to make recommendations that suit their unique risk, return, and impact profiles across many or all of their assets. And in fact, we do an exercise just like this with our students in our impact investing elective course, where real life wealth advisors provide anonymized profiles of their clients, and then our students design impact portfolios that align with those clients' needs. The challenge in this is that as more asset owners seek to deploy their assets in ways that align with impact goals, how do they know that the asset managers are actually walking the talk? What evidence can they access to prove that the managers they choose are not greenwashing, but are actually doing well on impact as well as returns? And this is where the balance and rigor comes in. How much time and effort does it take, and does it make a difference in where the dollars are allocated or what those dollars accomplish? Because you do have a financial return to manage at the end of the day as well. So the third point I want to make that relates to this is that there is a very large swath of new entrants who are experiencing the challenges that I just talked about in new ways. We're seeing that as this market expands, we have new players, often with much larger assets, who are stepping in. A growing number of asset allocators are making meaningful commitments to impact investing funds, and they have unique challenges. They represent a large segment of the financial services industry. They include asset owners such as pension funds, family offices, endowments, and sovereign wealth funds, and the entities that advise them, such as private wealth managers or outsourced investment managers. For many, this is building on their institution's commitment to ESG or sustainability, and it reflects a desire to make a more positive impact on people and planet alongside generating financial returns. But operationalizing these commitments has proven challenging for many of them, as the tools and competencies that are needed to actually invest for impact are actually a little bit different from those that are needed to manage financial and ESG risks. Further, as many asset allocators primarily invest through intermediaries, and that's what this chart is about. You're an asset allocator and you're choosing funds. So maybe you're a limited partner and you're an investor in a general partnership who is the asset manager. You're actually operating at a significant difference from then the company that the asset manager is investing in, who's actually having an impact. So while asset allocators are in this very essential role, they're powerful, they're large, they control the initial financial and impact conditions of the capital on which the rest of the chain depends. They're also at least 2 times removed and sometimes more in the capital chain from where impact occurs on the ground. So this is the context, these 3 points: large and significant across all asset classes and quite indirect. that I want you to keep in mind as we go back to the main question, which is increased disclosure the solution to greenwashing, or do we need increased active impact management to make a difference? And if so, what do funds actually need to do differently to be seen as good stewards of their investment capital? So that is the context that emerged for us last year, where our team at Case at Duke partnered with a group called Blue Mark, and with generous support from the Tipping Point Fund on Impact Investing, we initiated some research to address the learning hurdles confronting these asset allocators who are newly investing in impact funds. We recognized that the realm of expectations and practices around impact for asset allocators has been relatively unexplored. There have been some resources about how to do ESG. There had not been any on direct impact management. So our focus was on creating guidance for them about what are people actually doing now, hence the sharpened pencil on the cover of our report, which is kind of how do you get this started? What are the lessons of people doing this? And how do you manage this? And the context for the research is that we asked this in interviews and consultations with over 50 limited partners and general partners globally, and again in 3 in-person events that we held in 2023. So what did we find? So this is a a graphical summary of what impact management is today for most impact allocators around the world, or those LPs wanting to invest in impact funds. We divided their practices into what they do pre-investment, when they're selecting investments and getting ready, and post-investment, when they're monitoring and engaging. And you can see there's kind of 3 practices on the left and 2 practices on the right. Our guide is basically 5 guides about, what are the basic and advanced practices of each of these, what are some of the red flags to watch out for, and what are some of the overall questions to ask. And then we have words of wisdom with some direct quotes from investors all around the world. I'm just going to give you a tiny little sneak peek because the report has so much more in it. In terms of the pre-investment practices, they are developing very strong theses and governance structures to support ongoing impact goals. They are integrating that impact into what they do operationally, including changing their diligence process and also changing what they do beyond that. And they're also actually being very careful about developing a team that has the skills and capacity to support this work as it evolves. And so just to give you a taste of some of these, we interviewed a firm called NBC Investment, which said, for us, a gold star GP is one that has established very clear, measurable key performance indicators that align with their impact thesis. And so we're judging that alignment to see whether they are walking the talk. We had someone else from BlackRock that we interviewed who mentioned that monitoring to her also meant ensuring that the GP has fundamental research and operational practices in place that allow them, BlackRock, to decide, should we hold, should we trim, should we sell, based on performance on an ongoing basis. They're going to make active decisions about whether to hold that asset or to move on and invest it in an asset that might have more opportunity for impact performance. Another fund, Azalea Investment Management, expressed a very strong preference for the GP to have a team and management incentive structure linked to the achievement of specific impact targets. So that's a very concrete example of walking the talk, where this team is not going to be incentivized only by financial return, but part of their compensation is going to be related to the achievement of specific impact goals. And that's a very tight way of doing that. So those are all examples of what people are doing before they invest. In terms of what they're doing ongoing, the practices post-investment, we felt what we learned, what we heard, were even more critical and often more differentiating for the more experienced investors. The beginner investors would do the pre, and most of the experienced investors would go on and do more post activities. These include leaning into impact reporting and disclosure. There are more and more regulatory requirements about disclosure, and making sure that your GPs are aligned with whatever their jurisdiction requires. But they saw this as a baseline. They said this is actually necessary but insufficient for us to understand what you're doing. Just because you're fulfilling, the required disclosure is really not enough. And so they also work to evaluate how well the managers actually met their impact goals and then change their impact practices internally to support this. So in this area, we saw LPs doing things like including side letters that include their impact reporting requirements with their investees, conducting regular check-ins on impact with all of their investee funds. And several actually said, we need to do that more frequently than just annually. We need to have actual evidence and data, and we need to have the conversations about how well you're doing and what you're learning and why, at least quarterly, if not more frequently. We had quite a few saying, it's not enough for you to give us a KPI, a key performance indicator. We want to see reporting on progress relative to a set target or goal that you wrote down at the beginning of our relationship, or that we learned about at the beginning, right? So it's not enough to kind of say, we did 12 this year of something. Did you intend to do 10, or did you intend to do 15, and what happened? And then there was a definite theme of believing that good monitoring of these sorts of investments includes a process for taking action. So holding on to an asset that is performing well financially, but performing poorly from an impact perspective is no longer a good practice. You want to make sure that you are integrating financial performance and impact performance, and then acting on that on a regular basis, and seeing that your investee funds, the GPs who are managing impact assets, are doing the same thing in their portfolio, so that you can get rid of the non-performers more rapidly and make sure your capital is going to what its stakeholders intended. So here's just a quick snapshot. This is what our practice guides look like. You can see this, the sample words of wisdom. I actually just encapsulated the second one there for you. They represent, at this moment, a consensus on best practices of what large institutions can, are, and should be doing around impact management practices. And so I'll include a link to the final report at the end. At this point, I want to end my comments. I'm going to wrap up in a few minutes by highlighting some of our key findings across the globe for these new and experienced LPs investing for impact. And then I'm going to answer the question that I raised at the beginning, which I think you can probably guess my answer to at this point. Overall, there's just a huge amount of diversity in the organizational mandates of these very large LPs. To give you an example, they ranged in our study from individual high net worth individuals to people who are running development finance institutions who report to their governments, right? So dramatically different stakeholders, dramatically different mandates. And so there's a lot of customization in terms of how people are creating the framework to diligence and classify and make judgments about which impact managers to invest. There are also emerging standards. There's one called the Operating Principles for Impact Management. There's also the SDG impact standards. There are also the new accounting standards coming out of the IFRS. So there's a lot of guidance for newer asset managers and allocators. At the very least, people are saying, follow those standards. Like, that's where you should start. That is table stakes. Further, many LPs believe that most of their investment power comes in simply selecting the best investments, and that they have less room to influence the GPs once they've invested. That was true of most of the newer investors. But the more experienced investors, as I said before, really disagreed and said, no, the key here to performing well is monitoring the progress of your investments and then engaging in ways that support and improve impact over time. And that they spoke about this healthy conversation they were trying to have with their GPs about what was working, and said that's actually the most important part of this, because the kinds of impacts that you're trying to have, whether they're on climate or people or water or education or anything, or health or anything else, are often quite specific, and you need that detail. The LPs we interviewed said the new requirements on the regulatory front are really a floor. They're a beginning for the kind of decision-making information they need. And they want to see more effort by asset managers to report on their own impact achievements and challenges. And last, they were just very aware of this balance between I'm asking you for more things and you're already doing something hard. And they were very wary of overburdening their GPs and very hopeful that some of this would become standard practice and not a new conversation that they had to have every time they invested. So coming back to our question, is impact management essential to combat greenwashing? If the results of our interviews are any indication, I'd say the answer is definitely yes. Experienced LPs are going above and beyond normal diligence and management practices to assure and support impact performance by their impact managers. The practices are rigorous. They're also quite doable, judging by the diversity of funds and entities that are engaging with this work. And as more regulatory requirements converge, I predict that the practices of impact management will become more mainstreamed as well. In a sense, it's as if the impact investing marketplace has something very tangible to offer the larger ESG and sustainability market. We know how to do this. Here are the common practices. You can do it too. And it may be the solution that many are looking for to differentiate the investments that are walking the talk on impact and sustainability. And I will just mention one more thing before I go to questions, which is that we at CASE have been involved in teaching not only our students, but many other practitioners around the core practices of impact measurement and management. And we actually have a Coursera course that we were commissioned to develop by the UNDP, which is the organization in charge of the Sustainable Development Goals. We'll put a link to that as well, but we have about 30,000 people who have learned about impact measurement and management practices to date through our course, which we're delighted about. Great. So I'm happy to take your questions. And I will keep an eye out for those. The first one that I am seeing is, how important do you believe new regulatory disclosures, how important do you believe new regulatory disclosure requirements are then? So I think they're really important, but they're a floor. They are not a table, and they are certainly not a ceiling. Investors will continue to need basic, standardized, comparable information on their investments, but they also told us that they need context-specific details about what funds are learning and achieving in order to decide whether to stay, trim, or sell based on impact performance. So very few of the disclosure requirements today require information that compares your performance to goals. People can do that. That's an add-on, but without actually, reporting on how you did compared to a target, it's very difficult to know whether you're achieving what you intended. So what is the general status of ESG investing and all we are hearing about ESG backlash in the news? So that's a great question. There are some clear kind of trends going on, and there's a lot of, kind of chaos in the marketplace around ESG. There is certainly more scrutiny, especially in the US, especially in state legislatures, and especially among the states that we consider red, that are more Republican dominated or conservative. They have said that, we're not sure we want our funds, investing in these sorts of outcomes, and we think that it's, costing us money to do so. But there's also a more general conversation going on within the community of investors saying, we as fiduciaries are not able to ignore material risks to our investments. And so, again, state legislatures saying, if my constituents are pensioners in my state, and sustainable or climate risks are going to affect the likelihood that they will have a comfortable retirement, I absolutely must take that into account as I do this work. And so the same thing around, so there are material issues around climate for almost every company, and there are material issues around workforce if you hire anyone. So both of those things, the environmental and the social, are material in various ways for different industries. The standards are starting to represent that pretty well. But what we see is that the label may be taken away. The ESG label is kind of slowly being erased from websites and so on, but the management practice inside the funds is, if anything, doubling down. That is my impression across the investment field. Let's see if there's any other questions that we have here. We have about 4 minutes left, so if you do have other questions, please write them in. I'm seeing a thank you, which is great. You're welcome. I mentioned that our report is available. The link is here. Impact Due Diligence and Management for Asset Allocators. We have many more reports and other information available at the Case at Duke website as well. If there aren't any more questions, I'm going to wait 1 more minute to see if there are any others. Doesn't sound like there are. I'm going to tell you about what's going to happen next in this Fuqua Link in Live series. Next month, delighted to say we're going to have Professor Ronnie Chatterjee. He will be speaking on Wednesday, April 3rd at 12:30 about how federal funding is boosting private investment on climate innovation, as I referred to, and new technologies. And so we'll be delighted to see you all there. Please also be sure to follow Fuqua on LinkedIn to be alerted to these and other events. And thank you very much.